Hey guys, happy Friday and welcome back to Side Hustle Investing. It's me, John, again, and I just want to say this has been a good week. Work-wise, it's not been the best week. You've had some rough situations. I know you guys are in the same position as I am, just trying to make a living, save up for your family, take care of them, and we're going to do that together. But we're going to do it not just by working on the 9 to 5. We're also going to work on the side and invest our money to get to freedom faster. So why was this week a good week if work wasn't the best? Well, I'll tell you why right now. Boom. Good job out of you. So as you guys might have been following on Twitter or might have been in the same predicament that I was for several weeks, you're sitting there watching all the other states getting approved and getting their invitations sent out. And the guys in Florida, we're just kind of left hanging, left holding the bag. But finally, yes, they did get the invitation out to me, and I was able to happily sign up, put my money in, link up my accounts, and start placing my first few trades using Tastyworks. So let's go ahead and dive into the platform. I'm going to bounce between both the web and the desktop platform because I feel like now that the desktop platform is out, people think that it's the only way to trade on Tastyworks. You see on the TV show throughout the day that they do not use the web platform, and I get it because the desktop is supposed to be its flagship platform. But I want to point out as we're going through here, there are still some features of the web platform that definitely do trump the desktop platform at the moment. I know they're going to address it and make the desktop where you want to be, but also just as a personal reason for myself is I can't stream on the desktop platform from work, but hey, I can get on the web platform. So hey for lunch break trading. So let's go ahead and dive in here, and I'll start these videos off for my weekly portfolio reviews here on the portfolio page, and we'll start out with this view here to kind of show what my overall stats are at the moment. So right now, in my first week on the platform, I did place 4 trades. I'm making sure to keep my exposure in my portfolio relatively low. I respect the fact that I'm still very much a newbie, and so I don't want to have any more than 25% of my buying power tied up in margin or in positions at one time. So this is my education, this is my tuition money. I have no concerns about sharing where my net lick is with you guys and where my current cash balances are because, hey, this isn't my entire portfolio. This is what I'm doing to improve myself and hopefully help improve your trading success as well. So let's go ahead and get into it. So I put in $10,000 into the account at the beginning when I first signed up, and I'm now sitting here at 9,992 and 0.2 pennies over there. So that's pretty interesting. But that's not a concern at all because as you guys, if you're watching these other education platforms, or as I will continue to talk about, this is a waiting game. It's a game where the clock is actually on your side, which is very, very different to buying options. And so as we go through here, we go through position by position. I want to talk through, as I'm learning more about options trading, the little tidbits that I'm picking up on, and I'll share that with you guys along the way. So total profitability at the moment right now is, let me see if I can get my little drawing thing on, 98%. And what that means doesn't mean that all of my trades have a 98% probability. As we'll get down here, you'll see a 62%, 68%, 74%. I'm trying to make them right around that one standard deviation of expected move for each position. But this 98%, what does that mean? Well, what that does is it's my beta weighted total probability of profit. So beta weight, we'll have to get a whole separate video on that. But right now, we'll just go ahead and say I'm comparing all of my positions to the performance of the S&P 500. And a lot of that is based on here, the correlation to the S&P 500 over the last 3 months. And so what we see here, let's go ahead and expand this thing out. Let's blow you up a little bit. What this graph shows is the expected move of the S&P 500 over the course of the expiration periods of my positions. That was a lot of jargon. Don't worry about it. Basically, what it's showing is what's expected to happen in the S&P 500 over a time period that's very important, but we'll kind of cover that in a specific video. And what this graph shows, see if I can trace it nicely. What this graph shows is how all of my portfolios in aggregate, their overall performance, how it does given a move simply of the S&P 500. So it doesn't, it's kind of hard to wrap your head around. It took me a long time as well. So we'll keep harping on this topic because this is one of the key concepts that I think will keep me successful. And if you guys latch onto it and follow a systematic approach to your trading, I guarantee you'll profit as well. So what we see here in these red shaded areas is when my overall portfolio loses money relative to the performance of the S&P 500. So if we see here, let's see if I can go blue. We have, I'll draw them out here. We have the standard deviation lines of the S&P 500 here. So right now the S&P 500 is right around 228, so 228.97, so really almost 229. That's the current stock price. And my positions are all currently listed for the March expiration. So what this means is the expected move, the plus or minus 1 standard deviation move. I know this screen's going to get a little busy here, but the plus or minus 1 standard deviation move of the S&P 500 over the course of that length, that I think it's 49 days away from now, is between, let's say, 239 and 219 or so. These points here. So that means the expected move of the S&P is within that range. Now you see that if at expiration that happens, my portfolio is sitting up here right around $300 or so. I can't quite read where that y-intercept goes across, but the overall portfolio is making money at that payout range. So let's go ahead and clean this up because it's getting a little busy. So as we look further out, 2 standard deviations, if you guys are not there in your math classes or not paying attention, but that's 95% of the movement of this bell curve is expected to occur within plus or minus 2 standard deviations. So as you can see here, the break-even points, let's see, does this thing go green? It does. So the break-even points are here outside the 2 standard deviation range. And that is a huge boost of confidence for me. Now, again, I've only had these positions on for less than a week, some of them, but the fact that it would take a 2 standard deviation move for my portfolio to even begin losing money, I got to tell you that lets me sleep at night. So we'll cover more about this in future lectures, but let me just say this is a key component and a key concept for you guys all to capture as we're going through this options trading journey together. So let's go ahead and go through our portfolio. And what I want to show you also is some of these little features that are in Tastyworks Webs, which I'm sure are going to make their way to the desktop platform. But there's a lot of benefit of being able to see your portfolio in these nice levels. So again, we covered the 98%. We know why that is. Total extrinsic value. We'll cover extrinsic value in the future lecture, but this is saying basically what I could stand to win if everything goes my way over the course of the contract period. And these show my positions kind of in an overall profitability, how they're doing right now. So let's go ahead and go back to the table view and start walking through the positions we put on this week, which is easy this week because it's everything. So I put on, I think in order, I started out with my TLT position. And to do this, I'll admit the desktop platform, at least from what I've learned, the desktop platform is a better way to review the trade itself. But before we go into that, I also wanted to cover another feature of the web platform, which is still keeping me using it. So if we go to the grid view, and let's find TLT. So I know it'll be on here as well. So let's go ahead and just skim down. As I look at IV rank or implied volatility, Tastyworks is the best I've seen because they give you multiple ways of viewing your implied volatility in the web platform. As we look at the desktop platform, you'll notice that currently it only supports the rank, and that to me is a big deal. I'm a big statistics geek, and I have a personal problem with the way that the implied volatility rank is calculated. And we'll cover that in a second. So let's go ahead and first compare how TLT, here you are. When I look at the 1 year IV percentile, and again, IV has dropped a little bit over the last couple of days, but just follow me here. So we've got a 30 in the percentile, And if we click to the rank, we've got 24. Well, let me just explain kind of my thinking behind IV rank and IV percentile and explain why I say that I have a personal vendetta against it. So let's go ahead and split this off into two buckets. And let's call this IVR and IVP for percentile. So the way that implied volatility rank works, we're not going to get into any formulas. We'll just do this graphically, make it very easy and simple to understand. Is that if a stock implied volatility moves like this, and you're currently, let's say, about here, the way that implied volatility rank works is that it's going to take, and let's say this is a 1 year period, so 1 year. The way that implied volatility rank is going to work is it's going to take the high point, which is right about there, and the low point, which is right about there. And it's going to give you an overall rank, hey, of how far in this range this one single point is of the current implied volatility. So if this is, for easy math, if this is 100 and this is 0, this looks about right there in the middle. So this would give you a 50 IV rank. Now this is still a very, very good way of measuring it, but it misses out on a very key component. And I'll explain that in IV percentile. So now let's show a different example that'll be a very harsh example. Let's say that in the beginning of your time period, your implied volatility was very high. Oops, your implied volatility is very high. Oops. There it is. But then it kind of dropped down to a very low level and continued to slowly and gradually rise here. Now in this case, if we were looking at IV rank, it would only take into consideration that 1 point and that 1 point, and it would tell you, let's say that again, that looks about, what do you say, about 30% between the top and the bottom for that distance. Now that seems okay, and that's true that there was a point much higher, but that's just 1 point. And all you guys who have any math background, you know what an outlier is, and that 1 point very well could be an outlier that really has no statistical significance to the overall volatility of the stock. What IV percentile does to take that into account is it looks at every single day and its implied volatility of every single day along that year, and it weights it equally, and it gives the percentile, kind of like when you're going through standardized testing. You might not have gotten 100%, or let's say you might not have gotten a 95%, but you could be in the 95th percentile of performance of your class. If everybody did poorly, you were allowed to do worse and still be at a high percentile. And so I personally like implied volatility percentile better because I very firmly believe that outliers could throw off the IV rank calculation and tell you that a stock may be a bad choice for selling premium, or could be a good choice for selling premium, and just the opposite to be true. All right, so that being said, I chose TLT because it had a good implied volatility percentile over the course of the week. So let's go ahead and go into the platform and go to my positions tab here, and let's pull up TLT. I love the platform, by the way. I really wish my firewall allowed me to use it. So TLT was a very simple, standard $3 wide iron condor. And right now, if you look at my strikes I set it in, I set my short strikes right around the 1 standard deviation mark. It's actually pulled in a little bit. Well, that's why, because I'm not on the correct expiration. Let me go to my... This will work. I'll look at the table view. Sorry. Still learning the platform. Let's pull up 50 strikes. There we go. So here in the table view, stock is currently trading between 119 and 120. So I set my short strikes right outside the 1 standard deviation mark and gave myself $3 wide on each spread, which gave me a probability of profit. Let's just duplicate this trade. buddy. There you go. Around 70%, 50. I think I got around 60 cents for the trade. Let's go ahead and check. And this is where I'm still very, very new. So I got 60 cents for the credit and max loss of $244. So good, simple trade. Being it was my first trade, I didn't want to take a directional assumption and just wanted to have a nice neutral trade to start learning, watching the platform, as well as my own emotions now that I actually have real money invested in it. So let's go next to GDXJ. And this one I did just recently, and I did it very different. I decided that, throw caution to the wind a little bit. This is, again, my last trade of the week, so I was feeling a little more overconfident, I'm sure. So I did my first naked option. I did a strangle right around the 1 standard deviation mark. If I pull this up again. So again, very high probability of profit, almost 75%. Probability of reaching 50% max profit is 85%. So a very high probability trade for $121 of extrinsic value. And again, unlimited max loss. But looking at these strikes between 30 and 43, let's go ahead and take a look at the chart here. So 30 and 43, that line's right there. 30, right there. It's a very good range, especially for only a couple of months of movement or less than 2 months of movement. So also knowing that, the way that the mechanical adjustment strategy works, if the stock underlying price drops down to my short strike, or as it begins to approach down to my short strike, I intend to be managing this position by bringing that by bringing that call strike down closer to the put, and continuing to do that until, if need be, I could be in a position of having a straddle where the put and the call are both at that lower strike, and then from there we always have the option to roll out in time. Getting too far ahead of myself though, just place the trade. But I'm getting too far ahead, but it's also good to recognize that you need to have a plan when you go into your trades. So that's the plan. I want to have a set number of adjustments I make before I take my loser, and we'll see how time flies by. So now EWW, place a trade there as well. Let's go ahead and look at the curve view. And can I go out in time? I don't think I can go out in time without placing a trade, which I don't want to do. So let's go ahead and look at the table view. What I placed here, another iron condor, very vanilla, trying to keep my deltas in check. And so that was, again, a pretty simple trade. This one was also $3 wide. So looking for that 50% profit. And then finally, this was not my last trade, but it was the third to the last trade that I made during the week. And I actually placed it earlier today on Friday. And it was in Bristol Myers, which had its earnings announcement and started to see a little bit of an implied volatility drop, but not terribly bad. So if I go back, let me look at my notes on this. BMY, I think I took some notes. So my first directional trade, the implied volatility was 33.5, but the rank, I believe, let's see here. Did I put it in? I don't think I put it in. But the rank was definitely above 50 percentile. And so it was a good opportunity to continue to sell premium, especially given that earnings had just passed. I felt that it was a safe place to go. And at the time when I was placing my trade, let me take this one off. How can I take these off? I will learn how to do this over time. But before I placed the trade, I was negative some delta. It wasn't a lot, but I did want to have one directional trade on just so I could see how it would go over time. So I thought this was a good place for a short put spread. And the reason for that was, if I'm still on BMY, which I am, I mean, it's been getting pummeled throughout the course of the year. And I do like to do the contrarian play. If you were to look at the relative strength index, it was extremely oversold. So, if you got to go directional, I'd like to take a beat up stock to do it in. So the trade in Bristol Myers was a very simple put vertical spread. It was $2 wide. Didn't really want to take on $3 or $4 widespread here. Placed it a couple strikes below the current price and had some pretty good volume in the short strike that I just selected there, and picked up a, not an amazing credit, but a pretty good credit. So if I go over here, I received, I received $50 credit for that contract as well. So I'll be looking to close out around $25. And what's nice also about this is if I click into it, you can also see that I have the working order already placed that I will try to sell out at that limit, $25. So again, if I received a $50 credit and I'm closing out at 25, that means I should be netting $25 of profit. And that's that. So that was my first week. I do still have my health savings account in Thinkorswim with TD Ameritrade. So I'm continuing to trade that, but we're not going to go into it right now. I just made one more covered call in my XLU position, which is the utilities ETF. And my stock is not doing great, but the call option is. So if I go into XLU and pull that up, it's just been kind of lackluster here. I believe I sold the I think I sold the 49. I should know this, but I think I sold the 49 call, which is just a covered call. So that should be pretty uneventful, given that the commission rates at Thinkorswim are pretty darn high, especially for such a low priced underlying. I'll only be letting that expire. Hopefully worthless. So that's that, guys. I've had a great week. I'm looking forward to continuing to do this. And as I learn and get better at teaching as well as trading options, I look forward to being able to serve you guys in future lectures. So go out there, make some money, but realize that money is not everything. Enjoy your family, enjoy your life. I'll see you guys next time. Bye.